Okay. Good morning, ladies and gentlemen, and welcome to this COP event organized by the IPSF. That's the International Platform on Sustainable Finance. My name is David Rubens, and today we will look at how sustainable finance can fuel the transition to a sustainable economy. It's the IPSF's second anniversary, so happy birthday. And for this occasion, we've gathered 10 esteemed IPSF members and observers to share their insights in two different sessions. In the first session, we'll look at the IPSF activities of the past year, and we'll also look at the future as well. And the second session will focus on how sustainable finance tools can support the transition efforts. I hope you're all well awake now, because we'll kick off with opening remarks by Commissioner McGuinness. For everyone interested in sustainable finance, I would say the COP is about to become a whole lot better. Commissioner, the floor is yours.
Good morning, everyone, and I'm really happy to be able to address you this morning. And yes, David, I am wide awake, and I think all our participants on this panel are as well. So happy to be involved in what is, in my view, a central event here at COP, because it's billed as an EU side event. But I think all of us who are engaged in this issue know that what we're doing is central to the transition. Without money, we will not get change. And this event is about driving the transition to a more sustainable economy at the global level, with more globally interoperable sustainable finance approaches. It's about moving money, private funds, towards sustainable investments and providing guidance to corporates and the financial world on disclosures, transparency and accountability. And of course, finance is finance, but sustainable finance takes account of the sustainability impacts of projects that are financed. And as you said, David, the international platform is barely 2 years old, established back in the autumn of 2019. And the world then was a very different place. We were totally unaware of a pending COVID-19 pandemic. But of course, COVID is not the only challenge we faced over the last 2 years. We've witnessed floods, droughts, wildfires, heat waves, extreme weather events, which are becoming more frequent across the world. And I think it's the global nature of the challenge that makes international cooperation on sustainable finance so essential. It's why we need forums like the International Platform on Sustainable Finance. And the EU has ambitious climate targets, but we cannot tackle climate change alone. And that's why we need to work at the international level. So I'm glad to report that it has been a productive 12 months for the platform. The membership has increased, with authorities from Japan, the UK, Hong Kong and Malaysia joining us. The platform established itself as a knowledge partner for the G20 Sustainable Finance Working Group. And this morning, the platform published 3 reports. The first report on a common ground taxonomy, a report on ESG disclosures, and an annual report. And the publication of these 3 reports is a major milestone. And I want to use my time with you today to underline why that is the case. So first, let's look at the common ground taxonomy report. More and more places are embracing taxonomies to provide clear guidance to sustainable investments. These classification systems help scale up investments in projects that support climate and environmental goals, protect investors from greenwashing, and support companies as they plan their green transition. And of course, taxonomies are often connected to other sustainable finance tools, such as labels for green finance instruments or disclosure frameworks. Today's Common Ground Taxonomy report is a first step towards globally comparable taxonomies. It lays out the common features in 2 taxonomies, the European Union's and China's. It is a comprehensive factual activity-by-activity mapping and comparison of these 2 taxonomies. The methodology behind this report can be used to compare other taxonomies and to identify compatibility. So as new taxonomies are developed by different jurisdictions, they can be included in the analysis. And this methodology is a big achievement in itself, and it aligns with one of the actions of the G20 Sustainable Finance Roadmap. The report highlights the importance of developing taxonomies based on common sustainability goals and principles and using a common language. So today is an important step, but it is a first step. The Common Ground Taxonomy will evolve over time. The platform is looking at how to address some of the methodological challenges that remain, and it will examine how to broaden the scope of comparison to other features, other environmental goals, and other taxonomies. We're setting out on the road to improve comparability and to scale up sustainable investment at the global level. I want to move now to ESG disclosures and the report just published. In the European Union, we firmly believe that sustainability disclosures and taxonomies depend on and reinforce each other. Both are about transparency, providing the financial system with clear information about sustainability. In the European Union, we have introduced disclosure requirements for companies and investors, and we've developed tools to help end investors identify credible investment opportunities in line with the EU taxonomy. The EU will continue to advocate for ambitious international standards and principles for disclosure. We'll also keep pushing for comprehensive sustainability reporting standards that address all sustainability issues. And for us here in the European Union, the double materiality perspective is vital. So, if you like, recording both the impact of a company on the environment and the impact of the environment on a company. We welcome the International Platform's report on ESG disclosures. This is an opportunity to develop understanding of different disclosure frameworks, to identify emerging trends, and see where the gaps are. Ultimately, this will help increase transparency, comparability, and compatibility between the various ESG disclosure initiatives across the world. And finally, a look at the annual report for 2021. I really would like to take a moment to say thank you to everyone involved with the International Platform on Sustainable Finance for the hard work and dedication over.
You're muted. You've just got muted for the last 5 seconds or so.
Can you hear me now?
Yeah.
Okay. Honestly, it wasn't me, so somebody's okay. I want to just appreciate the work of the platform, everyone involved. So I was saying a big thank you, and it would be a shame to miss the thank yous because it's been impressive. Working globally isn't easy, and I appreciate all that you have done. Look, in terms of the progress, we've made very good progress, but we do need to stay focused on the future. If we are committed to the Paris Agreement, we still have a lot of work to do. So our next steps must be inclusive. Different jurisdictions in the international platform have different needs and different starting points, and we have to recognise that while always keeping the ambition high. We know that low and middle income countries need particularly significant investment to finance their sustainable development. So accelerating private financial flows towards our partner countries will be crucial to delivering on the global sustainability agenda. So in conclusion, climate change is a global challenge and it needs global cooperation. Finance and capital are global, and therefore this conversation is about how we match these two challenges. And I think this is true in many policy areas, and not least in sustainable finance. So seeing so many jurisdictions cooperating on the International Platform for Sustainable Finance is very heartening. 2 years ago, the platform and its members were pioneers. Now, if you like, sustainable finance policies are being initiated and implemented across the globe. We sometimes use different words, different concepts, or different methodologies. And that's not a problem, as long as we all move with determination in the same direction. COP26 is a moment to ask how we can work faster together on sustainable finance. In particular, it is a time to make sure finance is a driving force on the road to sustainability. We need to keep building on the achievements of the platform. Everyone here today is committed to reaching their individual and our collective climate goals. And we need to maintain this commitment to develop sustainable finance tools and frameworks that are comparable and compatible while taking into account local needs. It's a big challenge, but it's one I think we all have embraced already. So thank you for your attention this morning, and I wish us all a very good event. Thank you.
Thank you, Commissioner. We will now start with the first session on the IPSF activities of the past year and the way forward. We have the pleasure to have with us Dr. Ma Jun, who is co-chair of the IPSF Taxonomy Working Group and also co-chair of the G20 Sustainable Finance Working Group. Dr. Jun will let us discover the Common Ground Taxonomy and an IPSF report which was published this very morning. Dr. Jun, please go ahead.
Thank you, David. Can you hear me okay?
Yes.
Great. Thanks. And also thanks to the Commissioner for the opening remarks that refer to the Common Ground Taxonomy. As you know, IPSF launched a working group on taxonomy in July last year. This working group, which is co-chaired by EU and China and joined by many other jurisdictions, aims to produce a common ground taxonomy that could help improve the comparability and the interoperability of sustainable finance standards between major markets such as China and EU, and provide a reference for other jurisdictions that intend to develop their own taxonomies. I'm extremely pleased to announce that the working group just published the first version of the IPSF Common Ground Taxonomy report today on the IPSF website. The main body of this report includes methodologies for comparing different taxonomies and for identifying the common activities. The tabular annex of this report, which includes common activities recognized by both the EU and Chinese taxonomies as making substantial contribution to climate change mitigation, is released for public feedback for the next 2 months. A final version of this annex will be released soon after we have received the feedbacks. Let me thank the working group members for their great collaboration, and my special thank goes to the technical expert group, which made tremendous efforts over the past 16 months for developing the methodologies for comparison, analysis, and production of the Common Ground Taxonomy. The current presentation of the Common Ground Taxonomy combines the merits of both EU and China taxonomies. The Common Ground Taxonomy analyzes 80 activities across 6 sectors in the International Standard Industrial Classification, which are forestry, manufacturing, energy, construction, transportation, and waste management, including 2 innovative activities requiring multidisciplinary technical practices, i.e. underground permanent geological storage of carbon dioxide and hydrogen storage. 61 activities were included in the Common Ground Taxonomy activity table, and 19 are pending further analysis by the technical expert group and may be included in the second phase after the closing of the open feedback. Globally, the further development of the sustainable finance market, especially cross-border green capital flows, is being challenged by the proliferation of a large number of sustainable finance taxonomies that are developed in silo. This proliferation could lead to market segmentation, increased transaction costs, and the risk of greenwashing. The Common Ground Taxonomy is an important effort made by the IPSF to address this challenge. By highlighting major areas of commonality between the EU and Chinese taxonomies, the Common Ground Taxonomy helps increase the interoperability and compatibility of these taxonomies used in the major markets. It could also serve as a voluntary reference by interested parties and as an analytical tool and reference for other jurisdictions that are developing their own taxonomies. We're hoping that the Common Ground Taxonomy can help reduce the verification costs and facilitate cross-border green capital flows. The methodology underpinning the Common Ground Taxonomy is a very important part of this work. The first stage of the methodology work involved, number 1, using the EU Taxonomy Act as a basis, which is focused on climate mitigation. And secondly, extracting major climate mitigation activities from the Chinese taxonomy. Thirdly, mapping all activities in both taxonomies to a neutral code, namely International Standard Industrial Classification, so that we could map and compare and align these activities. Number 4, identifying and selecting common activities that are recognized by both EU and Chinese taxonomies that will significantly contribute to carbon emission reduction or sequestration. The second stage of the technical work involved evaluating the detailed descriptions and technical screening criteria for each line with a scenario based on the overlap. The report released today is the first phase of the work presenting a detailed analysis of and a common ground taxonomy based on the EU and Chinese taxonomies. In the future, other jurisdictions developing their own taxonomies could join the analysis, and the working group can expand the scope of its comparison. For example, Singapore and Sri Lanka are planning to publish their green taxonomies in the near future. In addition, as pointed out by the G20 Sustainable Finance Roadmap, sustainable finance taxonomies may be adapted to further recognize transition activities. As taxonomies evolve to include more transition considerations, the common ground taxonomy will also reflect these changes. Let me end my remarks here, and once again, big congratulations on the launch of the Common Ground Taxonomy report. Thank you.
Thank you very much. Maybe just a question. How could the current version of the Common Ground Taxonomy serve as a reference for different stakeholders, like market participants, governments, jurisdictions?
There are many use cases. Let me just give you a couple of examples. Number one, it could be used as a tool for comparing different taxonomies. This report presents the methodology for comparing taxonomies and methods for producing a common taxonomy based on a few taxonomies. In particular, it gives example on how to convert different taxonomies that used a different classification, namely the language, into the same language, and how to identify the overlapping areas of economic activity. The second usage is that it could be used by interested parties, including market participants, on a voluntary basis for developing green financial products. For example, Chinese issuers wanting to issue green bonds in Europe can consider using the Common Ground Taxonomy, and European issuers intending to issue green bonds in China can also use the same Common Ground Taxonomy. These efforts can avoid the duplication of verification costs. The third potential usage is that it could be serving as a reference for other jurisdictions when they develop their own taxonomies, or they can even just decide to adopt this Common Ground Taxonomy for their own use. In the longer term, I think we need to consider the possibility of using a building block approach to promote the harmonization of global taxonomies. And in that case, Common Ground Taxonomy can be used as a baseline building block. And based on that, the jurisdictions can add other blocks reflecting their domestic policy priorities.
Okay, very interesting. And so under the EU and China's leadership, the Common Ground Taxonomy work achieved the first significant milestone on the road to increasing global interoperability and compatibility of sustainable finance standards. But what are future directions of this work?
I think the taxonomy working group can continue its work in the next in the following few directions. One is comparing and analyzing more taxonomies. As you know, currently the Common Ground Taxonomy is based only on EU and Chinese taxonomies. In the future, when other jurisdictions in the IPSF community have developed their own taxonomy, the working group will include these into the analysis and comparison. We will then refine the Common Ground Taxonomy based on the expanded analysis. The second possibility or direction of our future work is the Common Ground Taxonomy could cover more areas. As I said, currently the Common Ground Taxonomy only covers climate change mitigation activities because the EU Parliament has only approved the Climate Act of the EU Taxonomy. And in the future, when the EU Parliament approves the other acts that covers areas such as environment, circular economy, biodiversity, then the working group will expand the coverage of the Common Ground Taxonomy accordingly. The third direction is really to following the suggestion of the G20. We need to work on options to further improve comparability, interoperability, and consistency of taxonomies. For example, we need to discuss how to promote the adoption of the common principles for developing taxonomies, and how to promote the usage of the same language, namely ISIC, in developing taxonomies. And the final point I'd like to make is that IPSF should think about how to work with other IOs to enhance capacity for emerging market economies in developing taxonomies. For example, IPSF can consider how to work with MDBs to assist developing regions such as ASEAN, Central Asia, and Africa for developing their regional taxonomy in a harmonized way.
Okay. Well, many thanks for these insights, Dr. Jun. Next, we have Mr. Satoshi Ikeda, co-chair of the IPSF ESG Disclosure Working Group and Chief Sustainable Finance Officer at Japan FSA, Financial Services Agency. Mr. Ikeda will enlighten us on another IPSF report that was published today, the ESG Disclosure Report. Mr. Ikeda, the floor is yours.
Thank you, David, for that introduction. Well, I'm very much pleased to join this IPSF annual event as a co-chair of the Disclosure Working Group. The event is showcasing the progress made by the IPSF and which have been significant. Well, so one of them is obviously the ESG disclosure work by the IPSF. And well, but before introducing the content of the report, I would like to express my big thank you to the DG FISMA and Federal Ministry of Finance of Switzerland, because they are co-chairing this working group together with Japan FSA, and I would like to particularly name Guido and Christoph for co-chairing this working group. I would like to also thank all the members of the disclosure working group. Well, because of the COVID-19 pandemic, we were not able to convene the physical meeting, but the input from the members have been very critical to formulating this report. I would also express my thank you to the Climate and Company and the University of Hamburg for collating those inputs and producing a report based upon the input from members. And I would like to particularly name Ingmar and Catalina for that. Well, our work compares the IPSF member jurisdictions and plus United States and Brazil in terms of their ESG reporting regimes. Well, because the transparency is a foremost important aspect of the promoting sustainable finance, actually the disclosure-related works are very much busy place for international organizations to produce their own reports. Well, obviously, yesterday that IFAS Foundation launched the ISSB, and IOSCO collaborated with IFAS Foundation and made their own report. FSB worked on the climate-related disclosure in terms of TCFD. So we try to produce our own value in that busy space and took stock of the national ESG reporting regimes, focusing on the regime taken by those IPSF members and the United States and Brazil, and also dealing with not only climate, but covers a broader spectrum of sustainability issues in terms of disclosure requirements. In those exercises, we adopted the 7 pillars and scrutinizing the structure those stock-taking analysis. One is the disclosure content. The another one is the mandatory or voluntary nature of the policy measure. The third one is the underlying definition of materiality. Fourth one is the scope of affected entities, products, and services. The fifth element is the assurance requirements. And sixth element, the disclosure channels through which the information is published And the second and last one is the reference to or application of disclosure standard or recommendations. Well, those exercises certainly shed light on the dynamically evolving field of ESG disclosure and come up with very interesting insights from the large range of existing and emerging approaches to implementing ESG disclosure framework. And this report certainly can provide a foundation for each IPSF member jurisdiction to further develop their respective ESG disclosure regimes on a voluntary basis and in accordance with their own legal frameworks and policies. And this report also will guide a way forward for even non-IPSF member jurisdictions of their ESG disclosure regime in the context of the global landscape of the development. So in that sense, this is a very much a milestone report by the IPSF, which contribute significantly to the global discussion of how to shape the sustainability reporting regimes and frameworks and standards. Thank you.
Thank you very much. Maybe just a question, what action will be needed, do you think, to enhance the interoperability or slash comparability of the ESG disclosure?
Well, certainly the consistency and the comparability of the reports are very much the requirement from the investor communities. So in order to ensure that, while the many jurisdictions take each national approach to the developing the disclosure regime, but those regime needs to be in reference to and being aligned to with the certain international standards and frameworks. Well, one of which could be TCFD, one of which could be IFRS Foundation's ISB, or in the case of the taxonomy, it could be common ground taxonomy work. So whatever form that the national disclosure regime takes, it is very important to connect those regime with the certain international frameworks and international standards. Well, when it comes to the discussion of materiality, well, some jurisdiction takes the course of the double materiality, and some jurisdiction may take the course of dynamic materiality. But it is important to make sure that the those disclosure regimes take into account outside in element and as well as inside out element. Those things will be very much prerequisite for developing the ESG disclosure regime going forward. And I'm very much confident that the IPSF ESG disclosure report will guide the work of IPSF member jurisdiction and together with the non-member jurisdictions going forward.
Okay, thank you very much, Mr. Ikeda. Our next speaker is Mr. Eddie Yu, Chief Executive of the Hong Kong Monetary Authority. Mr. Yu, Hong Kong has expressed keen interest in the Common Ground Taxonomy. Could you share with us the considerations and the way forward?
Thank you, David. Let me first thank and congratulate the two working groups for the very good work that they did on the Common Ground Taxonomy and also on ESG disclosure. And let me say a few words on Common Ground Taxonomy. We believe that the financial sector has a key role to play in directing finance flows to achieve the climate goals of the Paris Agreement. And Hong Kong being a major international financial center, we do recognize the importance of developing globally comparable and also interoperable sustainability alignment tools like the Common Ground Taxonomy in order to facilitate those flows. We believe that the Common Ground Taxonomy is a useful handbook for green finance. It points out the common features identified in the existing taxonomies, providing a core reference for defining sustainable activities, and also serves as a useful tool for jurisdictions which are developing their own taxonomies to align with the existing ones, yet taking into account their own local circumstances. So I see the Common Ground taxonomy as a key driver of convergence that facilitates the scaling up of international green finance flows. In the case of Hong Kong, given the large presence of European and Chinese financial institutions, we do have a strong case to build our work on the basis of the Common Ground taxonomy. In fact, last year, all financial regulators in Hong Kong already jointly announced our aim to align with the Common Ground taxonomy when it comes out. And we are now working to operationalize the details. We also support the IPSF's initiative to improve the quality and comparability of ESG disclosures. In fact, again, the authorities, the financial regulators in Hong Kong are working to implement TCFD-based climate disclosures across all financial sectors in Hong Kong by 2025. And we're also developing a roadmap to adopt the sustainability standards being developed by the IFRS Foundation. The Hong Kong Monetary Authority is very committed to developing sustainable finance, and we've put in lots of resources to build a sizable green bond program to accelerate the growth of the green capital market in Hong Kong. And COP26 is a great opportunity for us to further strengthen our commitment in contributing to the low carbon transition. The HKMA has already made an announcement on our commitment to integrate this into all of our functions, covering our roles as a central bank authority, a banking regulator, a market facilitator, and also a sovereign fund investor. Thank you.
Thank you. Maybe a follow-up question. The Common Ground taxonomy provides a good starting point for promoting the interoperability. So how would you envisage the next steps in terms of convergence?
Well, I think the Common Ground taxonomy, it does help us to navigate through the common elements of sustainable activities. But at the same time, it also sheds light on the areas of differences. And given the diversity of economic development and also the transition pathway across different nations, we believe that local specificities will be inevitable. And this is particularly so when transition activities are added to the various taxonomies. For example, supporting transition activities is especially relevant for emerging economies, which needs more financial and technological support along the transition journey. And this is crucial to enable a smooth transition for the global economy as a whole. So in order to promote cross-border green finance flows, we feel that there needs to be a way to deal with these areas of differences. And one thought is perhaps through some form of mutual recognition of transition activities, maybe this can be done. And maybe this is something that we should explore and aim to work out a solution, especially when a lot more taxonomies are now in the pipeline. And we stand ready to continue to support and contribute to the work of IPSF on this area. Thank you.
Thank you very much, Mr. Yu. Next, we have Mr. Shri Avanish Kumar Misha, Deputy Director General of the Department of Economic Affairs of the Ministry of Finance of India. Mr. Misha, could you please share with us your views on sustainability disclosures?
Thank you, David, for the opportunity. And at the outset, I would like to extend my warm welcome to all the distinguished colleagues and guests from around the world who have gathered to grace the occasion of second year anniversary of IPSF. And I'm happy that the workup platform is advancing in the right direction as the dialogue around channelizing sustainable finance has gathered right momentum among the member jurisdictions. Annual report of the ISF has aptly elaborated on the work of the IPSF during the year and progress in respective member jurisdictions. I'm glad to note that the continued commitment of members to channelize financial flows towards sustainable activities. I also applaud the work done on Common Ground Taxonomy report, which is indeed quite comprehensive and insightful. The Common Ground Taxonomy report is definitely a good reference point for the member countries who are thinking on the tangent of formulating one of their own. Here, I would like to state that India's taxonomy of sustainable activities are also under discussion in a task force constituted by Government of India in January this year. Apart from that, task force is also looking at other key issues of sustainable finance. India takes note of the report of the working group on disclosure norms and would like to appreciate the efforts gone into drafting it. I'd also like to take this opportunity to flag certain issues which impede the seamless functioning of financial players when it comes to disclosing relevant information. There is a need to overcome information challenges that exist by the way of lack of comparability, consistency, and quality of available ESG data, and the varying degree of scope, relevance, and completeness of sustainability disclosure regimes. The rise of different approaches to ESG and verification methodologies also pose challenges by creating the risk of greenwashing and lead to concerns about the quality of data being reported by the companies. I'd also like to highlight that social issues are equally important as any other related issues, especially in developing nations. Equal focus must be given to developing consistent metrics on the entire spectrum of sustainability topics. Talking of disclosure norms, I would like to mention that the Indian regulator of commodity and stock market, SEBI, has replaced the existing format reporting framework with new business responsibility and sustainability reporting, BRSR framework, thereby adding new dimensions to the meaningful engagement of business with their stakeholders. BRSR seeks reporting on quantitative and standardized parameters to enable comparability across companies, sectors, and time. BRSR also has introduced leadership indicators which are required at this stage to be reported voluntarily. What is worth noting is that allowing cross-referencing, we have facilitated companies which are already planning, preparing, and disclosing sustainability reports based on internationally accepted reporting frameworks such as GRI, SASB, TCFD, or integrated reporting. I hope that the new reporting format will shape India's ongoing efforts to develop responsible business with economic sustainability and inclusive growth. Globally, interoperable sustainable finance approaches are necessary. Addressing the issues of fragmentation in market is important. At the same time, it is also important that maturity of markets and level of development of economies are taken into consideration in application of such standards. One should also be mindful of the fact that such standards do not elevate risk perception of developing countries and should avoid one-size-fits-all approach, and therefore should encourage jurisdictional flexibility. We have emphasized this aspect in G20's Sustainable Finance Working Group also. India has always strived to take necessary initiatives to keep the sustainable development agenda on precedence. Its social as well as financial policies have always observed a synthesis of sustainable development goals. In this context, I am also happy to highlight that the Central Bank of India, RBI, had joined NGFS this year. I am confident that we would be learning more about how others are going to green the financial system. Last but not the least, I would like to highlight the importance of committed engagement and participation of regulators, policymakers, private sector, and financial institutions in pushing frontiers of sustainable and green finance, not just nationally, but cross borders as well. Thank you very much.
Thank you, Mr. Misha. Our last speaker of this session will be Ms. Liesel van Ast, Membership and Regional Coordinator Coordination Manager, of UNEP-FI. So Ms. van Ast, what are UNEP-FI's views on alignment approaches and initiatives such as the IPSF?
Thank you very much. I think that these initiatives are very important. I think And first of all, recognition overall at the COP26 of the crucial role of the global financial industry in delivering on the goals of the Paris Agreement is very welcome. I think when the 196 governments that signed the Paris Agreement included Article 2.1c there, that really gave financial entities a mandate to align financial flows with the Paris Agreement goals. And so in order to do that, financial institutions really need an enabling policy environment. And I think that's why the global work of initiatives such as the IPSF is so important, to enhance the policy support to align financing with the 1.5 degrees target. We really need global interoperability of sustainable finance approaches to accelerate sustainable financing efficiently and to reach the scale needed. I think so. Unify is a partnership between the UN Environment Programme and the global financial sector. We're really focusing on change at the level of financial institutions and at the broader systems level. And on both of these, we really welcome the European Commission's concrete steps to implement the goals of the Paris Agreement, including through tools such as the EU Taxonomy. I think these are critical to turn ambition into concrete action and practical action by the financial sector. So that's why we're working with the European Banking Federation to develop guidance for banks to use the EU taxonomy in core banking products. And that has applications such as using it as a tool for better engagement with customers on their transition alignment. So we also very much welcome the IPSF report on the common ground taxonomy for climate change mitigation. I think comparability and compatibility of climate taxonomies across jurisdictions is very important to align financing worldwide with the goals of the Paris Agreement. As an observer to the IPSF, we see the potential for synergies that it's generating to really have a normative role and to maintain high standards while encouraging others to step up. So that this is important so that banks, insurers, and investors worldwide have the enabling environment that they need to implement the finance strategies to transition portfolios to align with the 1.5 degrees target. We also welcome the IPSF's input paper to the G20 Sustainable Finance Roadmap. And as another knowledge partner of the G20 Sustainable Finance Working Group, UNEP's input paper set out a high-level framework that policymakers can use to understand what a credible 1.5 degree science-based target looks like for financial institutions. It's not a simple matter, and so we really try to capture some of the technicalities and methodologies of what implementing net zero targets will really mean for financial institutions and for the real economy transition. And initiatives such as the IPSF and also the Network for Greening the Financial System can really help to generate market guidance to steer capital flows, to have coherent definitions of economic activities across jurisdictions, and greater standardization of disclosure mechanisms. They can help really catalyze coherent policy support worldwide to enable transition finance strategies that we need to help deliver the 50% cut in global emissions that's needed by 2030. And we have just 8 years for policies to be implemented and deliver the cuts. So initiatives such as the IPSF can really help accelerate credible action that society urgently needs. I think in the absence of a globally agreed framework, voluntary leaders are making progress under collective commitments, including the UN-convened Net Zero Asset Owner Alliance and Banking Alliance and the Net Zero Insurance Alliance. And these alliances are working to align the 1.5 degree with the 1.5 degree pathway that we need for the Paris Agreement objectives. And for the Net Zero Banking Alliance, most of its 92 members, which represent over 66 trillion in assets, are also signatories to the Principles for Responsible Banking, which is a framework that ensures banks can align their businesses with the climate agreement and the Sustainable Development Goals. And transparency and accountability are at the heart of the principles. And this has really shown that through the first progress report of the signatories, that 87% of more than 200 banks are setting targets with the climate focus. So I think these landmark initiatives show how common action can create momentum, and the collective action both in the public and private sectors are important. We encourage it to accelerate. It won't be possible to realize the net zero ambitions without policy action to drive the changes in the underlying economy. And for this, the Net Zero Asset Owner Alliance has called on policymakers to align policy and actions with a 1.5 degree compatible pathway. Measures such as carbon markets can play a role in lowering the costs of achieving net zero targets and can lead to a shift in capital investment. Financial institutions really need an enabling policy environment to align financial flows, and we welcome the IPSF's contribution to this. Thank you.
Thank you, Ms. Van Ast. So in the interest of time, I think we have to move on immediately to the next session. Thank you to all the speakers of the first session. The next session is on how sustainable finance tools can support the transition efforts. So both at the national and international level, there is more and more focus and debate on options to scale up finance to support climate transition. So transition considerations will surely need to be part of the reflection and IPSF work. Our first speaker is Mr. Stefan Flückiger, Deputy State Secretary for International Finance of Switzerland. Grüezi, Herr Flückiger. Could you tell us how you think the IPSF could support the G20 Sustainable Finance Roadmap actions on transition?
Well, good morning to everybody from Switzerland, and thank you in particular to the Commissioner for her well-put introductory remarks. Indeed, the latest IPCC report this summer showed again the urgency of rapid and coordinated climate action. Private finance has become a priority for the COP26 presidency, and rightly so. It plays a crucial role to help companies realign their business models for net zero. I want to identify three potent levers to enable private finance realize its potential. Credible net zero pledges by financial institutions, transparency on alignment, and the international cooperation to develop such transparency. I'm elated to see the Glasgow Financial Alliance for Net Zero launch at COP26. And I'm encouraged to see so many financial institutions join by pledging net zero until 2050, among which I'm proud to say many Swiss institutions. I'm now eager to see how these financial institutions follow up on their pledges with credible short and midterm targets. To achieve their targets, financial institutions need transparency on alignment that correctly takes into account the transition of the real economy. Comprehensive approaches are starting to emerge. Such approaches calculate the current and projected emissions by companies in a portfolio and their contribution to temperature rises. They're forward-looking, thus capturing the transition of companies and economies as a whole. They're science-based, leveraging robust scenarios such as developed by the IPCC or the IEA. And they're simple to understand for the customer. For example, by stating that a portfolio represents a 3-degree warming scenario. To achieve comparability and interoperability, such forward-looking transparency on alignment is best developed by international cooperation. Thanks to the Italian presidency and under the leadership of China and the US, the G20 reactivated the Sustainable Finance Study Group and upgraded it to a permanent working group. We supported this wholeheartedly at the G20. The G20 Sustainable Finance Roadmap was a seminal product, and it proves it is the right forum to coordinate international work on sustainable finance. And in the midst of this, the IPSF emerged as a key knowledge partner to this working group. What a success for this young forum. And I thank the European Commission for its relentless support. In 2022, the IPSF could play an even more instrumental role within the G20. I expect the Indonesian presidency to place a focus on transition finance. The IPSF, on its side, is perfectly placed to contribute to this focus, both with the work on taxonomies, but also by expanding its center of attention to the portfolio alignment methods I just mentioned. Switzerland is ready to play an active role in doing so. It has been mentioned. Thank you very much.
Thank you. Maybe very short, does Switzerland already have experience with such portfolio alignment metrics?
Yes, look, very briefly. Together with the private sector, we are running a portfolio alignment test based on the so-called PACTA methodology since 2017. This is very interesting. In 2020, the latest test, some 180 banks, asset managers, pension funds, and insurance companies participated. So we got a representative picture of the entire Swiss financial market, with around 80% of all investments covered. We're not alone in this. countries such as the Netherlands, Austria, and Norway are using similar measurements to help their financial sectors align with the Paris goals. So look, Switzerland is keen in bringing this experience to ensure that the IPSF can play a leading role in transition finance.
Okay, thank you very much, Mr. Flückiger. Our next speaker is Mr. Ravi Menon, Managing Director of the Monetary Authority of Singapore. Mr. Menon, how do you see the integration of transition finance considerations into sustainable finance alignment approaches?
Thank you. Thank you, David, and greetings to everyone. And thank you for the opportunity to speak at this important event. First, let me congratulate the IPSF for the two very important reports it has just issued on taxonomies and on disclosures. And both of them are very pertinent to the discussion in this panel. Getting our definitions right and getting our disclosures right are key steps towards putting in place a robust and credible framework for transition finance. Let me make two quick points about taxonomies, interoperability and transition. So first, interoperability. We are unlikely to have a single global taxonomy. Instead, we should focus efforts on ensuring that taxonomies across different markets are interoperable and comparable. This is why the common ground taxonomy, which previous speakers spoke about, is so important, because it provides a useful framework for different taxonomies to achieve this interoperability and comparability. The second, transition. For Asia in particular, having a clear taxonomy that supports transition activities is critical. Why do I say this? Well, the outcome of the world's fight against climate change will depend very much on what happens in Asia. Asia accounts for about half of global carbon emissions. But Asia's journey towards net zero will not be easy. Most Asian countries are heavily dependent on fossil fuels for their energy needs. Some 45 million people in Southeast Asia alone are still without electricity. So Asia must find ways to transit towards greater sustainability in an inclusive manner. And this means progressively moving from brown activities through increasingly stronger shades of green over time. In the earlier panel, both Ma Chun and Eddie Yu highlighted this. And that is why the Monetary Authority of Singapore, together with the financial industry here, is developing a taxonomy that includes both green and transition activities. The taxonomy adopts a traffic light system that helps market participants identify activities that are green, yellow or transition, and red, which you need to get out of. And it sets out data-backed thresholds for each economic activity, taking into consideration the availability of alternative technologies in Singapore and the region for that activity. And the thresholds need to be calibrated at regular intervals so that we can keep pace with technological innovations towards greater sustainability. Let me close by just reaffirming once again MAS's strong support and commitment for the wonderful work that the IPSF is doing to lay strong foundations in the areas of taxonomies and disclosures. Thank you.
Thank you, Mr. Menon. Next is Mr. Tsuduri Sakamaki, Deputy Commissioner of International Affairs Office, Head of Delegation of the COP26 from Japan FSA. Mr. Sakamaki, sir, the floor is yours. You're muted. You're muted. Yeah.
Okay. Sorry.
We hear you now.
Wait. Thank you very much. Thank you very much. Now we are talking about transition finance. Why transition finance? Because our goal is net zero. Reaching net zero requires a long time, and reaching net zero requires mobilizing vast amounts of private funds in addition to public funds. Of course, we have already developed mobilization tools, such as taxonomy and ESG rating, but these tools are not enough. As we know, how important transition finance is has been demonstrated by G20 summit, and it has approved a sustainable finance roadmap, which includes action plan to develop transition finance principles. But the question is, two questions: how to draw pathways and how to trust pathways. Transition pathways are diverse across regions and sectors and even companies. Nobody doubts that transition pathways are changing dynamically over time. Under these circumstances, how we could make pathways credible among investors and other market participants? Obviously, there are no absolute solutions, no single solution to this question. Looking at some countries, they are already trying to incorporate transition elements into current taxonomies. In Japan, for example, it is now newly adopting industry-specific roadmap approach. In this approach, sectoral pathways are being developed based on which each company will formulate its own transition strategy. And then external parties comes in and then evaluate the credibility of these strategies. So we will see many various fund mobilization approaches in the future, but the key, again, is comparability and also credibility. So comparability among different, diverse approaches, and also appropriately assess the credibility of transition pathways. Transition pathways must be something definitely contributory to net zero Paris Agreement goals. So I'd like to conclude my intervention by reiterating our shared strong determination that IPSF members will continue to contribute in this super challenging climate space. Thank you very much.
Thank you. So our next speaker is Mr. Ambroise Fayol, Vice President of the EIB. Mr. Fayol, could you tell us how you see sustainable finance tools support transition efforts?
Very much, and I hope you hear me well. Good morning from Glasgow. Just three very brief points. So one, full support again from the Bank of the European Union, EIB, to the development of international sustainable finance initiatives and standards, and to the Common Ground Taxonomy report. To where we are at EIB, we have aligned all our financing activities with the goals of the Paris Alignment Agreement since the beginning of 2021, and we're going to increase significantly the share of what we finance under climate action and environmental sustainability to 50% of our projects financed every year by 2025, with this green finance being tracked against the EU taxonomy as it's a sectoral guidance over time. In the meantime, for sectors not covered yet by the taxonomy, we are going to use the new MDB IDFC common principles for climate mitigation tracking, which are also highlighted in the IPSF annual report and as another international harmonization effort, and we very much welcome this. Now, looking forward, the question for us is that it's important to be able to understand the differences amongst all types of activity that are not classified as green. In short, the taxonomy should allow us to define three categories of activities: those that are green, making significant contribution; those that are not green but that do not see significant harm, that are Paris aligned; and those that are not okay. And we should clarify how the criteria will evolve over time. That's an idea that the EU platform is working on. The taxonomy must be able to define such wider transition efforts. We must be able to mobilize financing for these activities to facilitate that transition to a performance level that does not cause significant harm, and therefore is Paris aligned, and which will not and which will continue to improve over time. Providing the necessary clarity on non-green activities in the portfolio can enable companies, investors, and other entities to better understand, develop, and explain their transition stories, improving access to financing for these transitions. At EIB, we believe this is extremely important that we move forward on this project. I'll stop there. Thank you very much, David.
Thank you. So we have less than a minute left for Dr. Rodolfo Lesi, Director at the OECD. The floor is yours.
Thank you very much, David. I would like to thank the IPSF Secretariat for the kind invitation we received to join this second anniversary and an annual event of the platform. The OECD is really honored to serve as an IPSF observer. I think that we are in a very decisive time. The economic recovery from the COVID-19 pandemic provides a unique opportunity to reorient financial flows and investment in the transition to a net zero. Of course, many policies and market practices still encourage emission-intensive investment, production and consumption, and emission continues to be unevenly and insufficiently priced. We need to urgently improve the alignment of all forms of finance and investments with the objectives of the Paris Agreement and with broader goals of sustainability and resilience. This also requires accelerating the reallocation of existing capital to enable high-emitting activities progressively shift or transition to lower emission pathways while avoiding locking emission-intensive technologies. The G20 Sustainable Finance Working Group under the Italian G20 presidency recognized the importance of transition finance and provided a clear and ambitious roadmap to better integrate transition finance considerations into sustainable finance alignment approaches with support of the OECD, IPSF, and other relevant partners and international organizations. So you know that the OECD recently undertook a stocktake of 12 transition finance related taxonomies, guidance and principles developed by both the public and private sectors to highlight commonalities and divergences between approaches, including on eligibility criteria used for defining transition activities and different pathways. The OECD paper finds that important differences exist among transition finance approaches developed to date, including differences with respect to eligibility criteria, of course, but furthermore, new approaches continue to be developed. This is a good sign as the transition to low-carbon, climate-resilient economies is a multi-trillion-dollar opportunity, and this transition must be greatly accelerated. I would like to finalize saying that access to finance is emerging here in the COP26 as a new prominent topic or issue in the negotiations. It's not about the amount of money, but about the real mobilization and quick mobilization of the money. I will stop here because we are running out of time.
Thank you very much, Mr. Lacey. So this concludes our IPSF event. I'd like to sincerely thank all the speakers for sharing with us their insights. I would like to remind everyone that the reports are online on the IPSF website. Go check them out. Thank you for watching and see you next year.